everyone. Can you hear me, please? The finance available is 300 million. All right. Sorry. The finance, let's say 300 million, and the finance available within the organization is 250. 250 is finance required of 300 million. Therefore, there will be a constraint. So since the financial resources of 250, how the company will allocate it among competing investments is you will observe that project A, B, and C financial resources of 300. How the company will allocate it among different viable projects. Rationing is the process of allocating limited scarce resources among competing investments or projects in a in order to achieve benefits or to increase value for the purpose of maximizing the wealth of the owners.
Excuse me, Mr. Adejomo.
Yes.
Adejuwon, we are losing.
Go
It
ahead.
ceases. When you
I
talk,
can't.
after a while, it ceases. We stop hearing you, then you come back, and it ceases again.
Oh, can you hear me now?
I don't know whether it's unique to me, but that is where I can hear. I'm hearing you.
It's okay, but you can you hear me now?
Now we can
Yes.
hear you, sir.
Can you hear me now?
Yes, sir.
You've gone again. We've lost you again.
I want to be sure you can hear me clearly now. That's what I'm asking. Can you hear me now?
I can hear you, sir.
Jide, can you hear me?
Yes, I can hear you, sir.
Okay. I hear me.
I can hear you, sir. Sir, I can hear you, but partially, sir, it's not complete.
It's my network. Maybe my network is not stable. Okay, so let's just go ahead. So what I'm trying to say in essence is that capital rationing involves the proper share resources among competing projects or investments in order to achieve benefits for the organization or to increase the value of the company, which will invariably maximize the wealth of the owners. So when there is capital rationing, the limited scarce financial will need to be allocated among the competing projects in such a way that will enable to maximize benefit for the organization. That's basically what capital rationing is all about. Just like you at skills level under performance management programming. So because resources, therefore the little that the company has, how is going to allocate it among competing about. Basically, there are two reasons or causes of capital rationing. One is internal capital rationing, and two, external capital. The internal capital rationing will arise when a company deliberately and a company intentionally impose its own capital rationing. We said that is internal. Okay, it could be called internal capital rationing. What are the causes? What are the reasons for rationing? One is the desire to maximize return of a limited range. If a company is not exposed to market opportunity, okay, so the company may be satisfied with the little benefit or opportunity. All right. So then number two, that of managerial requisite managerial skills. All right. If okay, if a management is not innovative to be able to take that will also prevent the company from be able to source for sufficient funds to evaluate the viable projects. So when there's debt or lack of skills for the purpose of taking advantage of market condition, that will limit the capacity of the company able to take advantage of the management may not be willing to to issue additional share capital. When a company wants to raise capital through raising equity capital or through debt. So if a company inviting public, you are inviting investors to come and subscribe to your shares. Results that will dilute the ownership control issues to the new investors. As a result, the existing shareholders' proportionate holding will shrink. Okay, so the company may not be willing to do that. We have because they don't want anybody to come and dilute their ownership. Again, shares because they don't want their share. They may lead to dilution of any part. Okay, so these are some of the reasons. These are some of the reasons for internal rationing. So you can just go through that. The second one is the external capital rationing, which by some factors that are external to the company, that are outside the control of the business. Somebody hear me now? Is it better or is it the same?
I think your line seldomly goes off when you're talking. We can hear some part and we can hear the other part. It seldomly goes off.
Oh, it's my network. I don't know what's happening tonight. Just give me 1 minute. Give me 1 minute. Let me. Please let me know. Can you hear me clearly now? Is it better?
Yes, sir, it's better now.
Okay. Hopefully the network will be stable again. Sorry about that. I didn't notice. So we are talking about the reasons for external capital rationing. Government restriction bank lending can prevent a company from sourcing funds from the banks. So as a result, the company will not be able to source for funds to execute the project. So generally, at times government can increase the MPR. So when that happens, so or there may be a kind of policy that CBN will introduce, which may prevent the banks from issuing loans to prospective investors, okay, for them to be able to undertake a project. So when there's restriction on bank lending as a result of government control, so that may prevent because it's beyond the company's control. Then the second one is raising money through stock market may not be possible if the share prices are depressed. So when the share price is reduced or depressed, it will not be attractive. The shares of the company will not be attractive to the to prospective investors as a result. they will not, investors will not subscribe to the company's shares. Not only that, some lending institutions usually consider small organizations or small firms to be too risky, to be granted additional loan facility because of the fear that the management of the company may run away with their money. All right. So as a result, the company will not be able to borrow money to finance the project, which may limit the ability of the company to execute viable investments. So you can just go through the material to read more about the reasons for capital rationing. All right. Now, there are two major types of capital rationing. There is single period capital rationing and then multi-period capital rationing. The single period capital rationing occurs when financial resources is limited for a year and capital is expected to be freely available thereafter. Okay? So when financial resources is limited within a year and then capital is expected to be freely available thereafter, that is a single period capital rationing. Under the single period capital rationing, the profitability index or benefit cost ratio can be used to rank viable investments for the purpose of allocating the limited scarce financial resources. All right. So we are going to come back to that one later on. Then what is multi-period capital rationing? The multi-period capital rationing is a situation whereby capital is scarce. Okay, it's scarce for more than one period. Under this situation, linear programming is expected to be used to determine the optimal allocation of resources. In this case, you are not required to solve, okay? You are not required to solve in the determination of which projects to select. The most important thing you need to do is to just formulate the linear programming model. Then thereafter, that's all. That's the main thing. Then how do you formulate the linear programming model? Let me see if yes, I have it. So no need to go and write it in the working notes. All right. So just like the normal way you formulate linear programming model, so the first thing you need to do is to state the objective function. To state the objective function, there is only one objective to be achieved, which is maximization of NPV. So your focus is on the project that are financially viable. Any project that has a negative NPV should not be considered. So the first thing you are going to do when you want to formulate the linear programming model is to compute the NPV of each project. So you now select any project with a positive NPV. Then step 2 is to state the objective function, which is to maximize the NPV. Okay, so the NPV you have computed for each of the projects, say for example, in this case, you have 5 million naira for project A, that's 5 million naira. 3 million naira of project B, that's the NPV of project B. 6 million naira of project C, that's the NPV of project C. So with this, I have stated the objective function. Step 2 is to state all relevant constraints. Remember, we said that under multi-period capital rationing, capital is expected to be scarce for more than one period, okay? For more than one period. So what that simply means is that, for example, in year 0, the finance available may not be sufficient. In year 1 or year 2 or any other year, the finance available may not be sufficient. As a result, provided you have it's a multi-period, then you have to state your constraint, which is in whatever year of constraint. That's what you are going to include there. In this year of constraint, of course, in this case, we are saying that in year 0, okay, in year 0, for example, the initial outlay of project A is 50. Initial outlay of project B is 100. Project C is 80. Then less than equal to 150,000. It is only 150 million that the company has in year 0. Meanwhile, the finance required is more than that. But again, that's why it's a constraint. Then you move to the second year of constraint. Say, for example, in year 1, okay, there's constraint also in year 1. So the finance available in year 1 is limited to 70 for project A, 80 for project B, 100 for project C. Then the finance available is just 130 million. So with this, I have stated the constraint. Okay, I've stated the constraint. Then the next thing you need to do is to state the non-negativity constraints, which state that cannot be negative NPV. Negative NPV is not permitted, and the least that can be, the least NPV should be equal to 0. And that's why we are saying that project A, NPV of project A, B, and C must be equal to or greater than 0. All right? Because you cannot have negative NPV. Because once you have negative NPV, it means technically the project is not financially viable and should not be undertaken. But the non-negativity constraint is saying that the least NPV should be equal to or greater than 0. Then finally, when you are formulating the linear programming model, you have to state the non-repeatable condition. The non-repeatable condition is saying that project cannot be repeated, brought forward, or delayed. All right, you cannot delay projects and cannot brought it forward. So that is what non-repeatable condition is talking about. Which states A, so which means that project A, B, and C is less than equal to 1, just like you have probability of 1. All right, so just master this. Whenever you want to formulate a linear programming model under capital rationing, this is the format you are supposed to follow. That is the format. It's as simple as that. All right, so you can read the limitation of capital rationing and then the assumptions, okay? And the assumptions of capital rationing, okay? These are the underlying assumptions of capital rationing. Just go through it, and that's it. Now, I want to explain the main concepts which you are likely going to see on the day of your exam, which are the situations in capital rationing. All right, let's talk about the situations in capital rationing. There are 5 key situations that can arise in capital rationing. 1 is perfect capital market. 2 is divisible project. 3 is indivisible project. Then 4 is mutually exclusive project. Then 5, mutually dependent project. Therefore, what do you understand by perfect capital market? All of you, when you were undergraduates, you did, especially those of you that study management science course, you borrow economics, all right? You did some part of economics when you are undergraduates, especially 100 level, 200 level, and all of that. Now, you might have been taught the future or characteristics of perfect markets. Therefore, when there's perfect capital markets, there's free entry and exits. Information is freely available and the investor can borrow without limitation. Provided the investor can borrow without limitation, then there is no capital rationing. So if the examiner has painted a scenario for you that the company is currently in perfect capital markets, it means that there is no capital rationing. Therefore, any project with positive NPV should be selected. I repeat, under perfect capital markets, investors can borrow funds. If the investor wants 1 billion naira loan, they can get it in the market. Because there is no restriction, no constraints. Therefore, any project with the positive NPV should be selected. All right. So whenever you see a scenario in a question whereby the examiner is telling you that the company is currently experiencing perfect capital market, you should know that there is no capital rationing. Okay. The second one is divisible projects. Divisible project simply means that fractional parts of the project can be undertaken, so that it's not compulsory that the project must be wholly financed. So you can finance part of the project in theory, all right? So you can finance part of the project. Therefore, under divisible projects, the following procedures should be considered. One, you compute NPV, okay? You compute NPV of each project, and then you select the project with positive NPV. I repeat, under divisible projects, the first step that you are going to carry out is to compute NPV for each project and select the project with a positive NPV. Any project with negative NPV should not be considered at all. Then step 2, calculate profitability index or benefit cost ratio. Step 2, calculate profitability index or benefit cost ratio. Step 3, rank the PI or BCR in a descending order, that is according to highest profitability index or benefit cost ratio. Then step 4, allocate the limited scarce financial resources among the competing projects. Step 4, allocate the limited scarce financial resources among the competing projects. Then step 5, you select the project to be undertaken. So those are the procedures you need to carry out when you want to allocate the limited scarce resources among competing projects where you have divisible projects. Now, let's talk about profitability index. Let's talk about profitability index. The profitability index measures the total value achieved from the amount invested in a project. I repeat, profitability index measures the total value achieved from the amount invested in a project. So it represents the ratio of the total present value to initial outlay. I repeat, profitability index represents the ratio of total present value to the initial investments, okay, or initial project, initial outlay. So it is computed as the total present value divided by initial investment, or benefit cost ratio plus 1. You know, when you compute NPV, we said NPV is the difference between the present value of cash inflow and present value of cash outflow. So those positive present value that you have computed, that's your total present value. Then you now divide it with initial outlay, your cash outflow. So that will give you the profitability index. Say, for example, NPV of a project. The project produced NPV of 10 million naira, and the initial outlay of the project is 100 million naira. Therefore, when I want to determine profitability index, we say profitability index measures the total value achieved from the amount invested in a project. Therefore, what I need to do is to get my total present value. My total present value, my PV, my total present value will then be equal to the NPV of 10 plus initial outlay of 100, then divided by the initial outlay of 100. This will give me 1.1. So the one you are seeing there is the 100% you invested in the project. The 0.1 is the benefit the company earned on the project. So the total value the company has earned on the project is what is called profitability index. Okay? Then the benefit cost ratio measures only the benefits earned from the amount invested in a project. So in this case, when I want to calculate benefit cost ratio, it's simply the NPV divided by the initial outlay. Okay, NPV divided by the initial outlay. From my little hypothetical numbers, if I want to calculate benefit cost ratio, since my NPV is 10 million, so I will say benefit cost ratio is equal to the NPV of 10 million divided by initial outlay of 100. This will give me 0.1. Okay, that will give me 0.1. That's the benefits the company has earned on the amount invested in a project. Okay, so that's that. So, yes, The third one, we have talked about divisible projects. So let's talk about indivisible projects. Indivisible projects are projects that cannot be fractionally undertaken. They are projects that must be accepted wholly, okay? They are projects that must be accepted wholly. So you cannot take fractional parts. You can't take, say, for example, 70%, 80%, or 1/3 of a project. It's not possible. You can't take fractional part. It's either you accept the project 100% or you do not undertake the project at all. Those are indivisible projects. Therefore, under the indivisible project, the most important thing to do is to carry out project combination, okay? Under indivisible project, the most important thing to do is to carry out project combination. So how do you carry out project combination? Very simple. First thing first, you need to go ahead and compute NPV of the project, okay? You compute the NPV of the project, then thereafter, you begin to do trial and error. You combine projects together, carry out project combination through trial and error. Say, for example, you have project A, B, C, and D. So to carry out project combination, you are going to be adding the outlay of each project together. Say, for example, I can add project A and B together. If the initial outlay of project A and B is not more than the it's not more than the finance available. But if the initial outlay of the combined project is more than the finance available, then I cannot combine. Okay, so you can only combine projects together provided the combined initial outlay is not more than the finance available. Then step 3 now is to allocate the finance available among the competing projects. How do you do this? Like I said, just add up the NPV, the initial outlay of the two projects. Then you now consider surplus funds, okay? You create a column for surplus fund, then you select, you have a combined NPV because you are combining the initial outlay of the combined projects. Then you must also combine the NPV. So at the end of the day, any combined project with the highest combined NPV will be selected. So when there is indivisible projects, there is likelihood of surplus funds. So these surplus funds can be invested or cannot be invested depending on the reinvestment rates associated with the surplus fund. Say, for example, we have combined project A and B, and the combined NPV of the A and B is 100. Say the finance available is limited to 120 million naira. Meanwhile, you have combined A and B. Let me write this. Okay, A and B, you combine A and B together. And then this is the combined projects. This is combined outlay. Then you have surplus funds. You have surplus fund, then you have combined NPV. So what I'm trying to say in essence is that after combining the outlay of project A and B, of course, this is 100. 100 is within the finance available of 120 million. Therefore, surplus fund will then be the finance available minus the combined project, which is 20. Then let's say combined NPV is 40, for example, and we have accepted this project. Now, what we are saying here is the fact that whenever there is indivisible projects, there will be probability for surplus fund. There will be likelihood of surplus funds. So these surplus funds may be invested or not, depending on the reinvestment rates associated with the surplus fund. So the surplus fund can only be invested if the reinvestment rates or cost of finance associated with the surplus fund is higher than the company's cost of capital. So provided the reinvestment rate associated with the surplus fund is higher than the company cost of capital, then the surplus fund should be invested. However, if the reinvestment rate is lower than the company's cost of capital, the surplus fund should not be invested. Rather, it should be returned to the shareholders in form of dividend or bonus shares. Okay, because if the surplus fund is with a reinvestment rate that is lower than the company cost of capital is invested, it will bring about a diminution in the wealth of the shareholders. So just note that whenever you are asked to invest the surplus, whether to invest surplus fund or not, so you must take into consideration the reinvestment rate associated with the surplus fund. So provided the reinvestment rate is higher than the company cost of capital, the project should be, the surplus fund should be invested. But if the reinvestment rate just like interest rates associated with the surplus fund. So if the reinvestment rate is lower than the company cost of capital, the surplus fund should not be invested, but rather should be returned to the shareholders in form of dividend or bonus shares. So to confirm, you may need to calculate the NPV of the surplus fund, okay? You may need to calculate the NPV of the surplus fund. So the NPV of the surplus fund is computed as the reinvestment rates, okay? The reinvestment rates, R is the reinvestment rates, SF is the surplus fund, then K is the company cost of capital. So at the end of the day, if provided your NPV of the surplus fund is positive, it means that the surplus fund should be invested. But if the NPV is negative, then it should not be invested. So if invested at negative NPV, of course, it will bring about a diminution, a reduction in the wealth of the shareholders. So the fourth one is mutually dependent, okay? Let's talk about mutually dependent projects. We said that mutually exclusive projects are competing projects in which the acceptance of one will preclude the acceptance of the other. So the projects that cannot be undertaken together are what is known as mutually exclusive projects. So under mutually exclusive projects, the most important thing to do is to create two hypothetical groups and make each mutually exclusive project to add each of the groups. And then at the end of the day, any of the group with a higher total NPV should be selected. So that's what you need to do under mutually exclusive projects. That's what you need to do under mutually exclusive projects. So just follow the procedure. We are going to have live questions so you understand better. Then the last one is mutually dependent projects. The mutually dependent projects are projects that must be accepted or rejected together. There are projects that cannot be separated. They are joint projects. Okay, they are joint projects. So under mutually dependent project, what are you supposed to do? Simple. You calculate NPV of all the projects. Then you combine the outlay and the initial the outlay and then the NPV of the mutually dependent project together. Then step 3, you compute profitability index or benefit cost ratio of all the projects. Then step 3, you allocate the finance available. Then step 4, you select the projects to be undertaken. All right. So those are the 5 situations that can occur as far as capital rationing is concerned. Okay, so you can just go through the material and read more on any other informations you have there. Then at this point, let's have an illustration. Let's have illustration. So let me start with a question that will take into consideration most of all those situations. Okay, let me see. So let's have this illustration number 5. Let's have the illustration number 5. I need one of you to read for us, please. Who is reading? Who is helping us to read?
Dandy Banty International has identified the following projects. Project A, B, C, D, table as follows. You are required to advise in the following circumstance. A, the company faces a perfect capital market where the appropriate discount rate is 10%. All projects are independent. B, the company faces capital rationing in year 0. There is only 650,000 naira finance available. Which project should the company accept? C, the company faces capital rationing in year 0. There is only 225,000 naira of finance available. None of the projects can be delayed. Which of the projects should be accepted? D, the situation is as in C above, except that you are informed that projects A and B are mutually exclusive. Which project is to be accepted? E, the situation is as in C, except that you are now informed that projects A and B are mutually dependent. Which projects should be selected? F, all projects are now independent but indivisible. Which project should be accepted? Assume that there are no alternative investments available for any surplus funds. G, same as F above, except that you are now told that surplus funds can be invested to produce 12% in perpetuity and 8% in perpetuity. H, all projects are independent and divisible. There's capital rationing in year 1. No project can be delayed or brought forward. Which project should be accepted if the maximum external finance available is 150,000 naira? I, provide a mathematical programming formulation which would assist the directors of Dandy Banty PLC in choosing investment projects if capital available is available. Year 0 is limited to 225,000 naira. Capital available in year 1 is limited to 150,000, and capital is freely available thereafter without limits at 10% per annum.
Thank you very much, Gbemi. That is the question. So let me stop sharing this and move to the working notes so that we can quickly solve the question. Okay. Now, in the A requirements, you are told that, okay, before that, the name of this company is Dandy Banty International. So I will come here, Dandy Banty Solution. So illustration 5. Dandy Banty International. So in the A requirements, examiner has told us that the company faces a perfect capital market where the appropriate discount rate is 10%. All projects are independent. When I was explaining, I told you that when there's perfect capital market, let me just put it there. So perfect capital market. Okay, that's the situation. So to solve this, just say when there is perfect capital market, information before that, there is free entry and exits. Command information is freely available. And investor can borrow without limitation or without restriction. Let me write that. Okay. Therefore, any project with a positive NPV should be undertaken. So I will then go to the question. I will go and calculate NPV. So if NPV is given to me, then I will select all the project with a positive NPV. So let's go back to the question. When you look at the NPV of project A to E, you will notice that only project C has a negative NPV of 20,000 naira. Therefore, project A, B, D, and E are viable projects. So hence, projects A, B, D, and E with a positive NPVs should be undertaken. So I've answered the first requirement. I've answered the A requirements because the examiner has told me that there is perfect capital market. And when there is perfect capital market, there is no restriction. So any project with a positive NPV should be undertaken. So that's the basis of our selection. Then let's go to B part. In the B part of the question, you are told that the company faces capital rationing in year 0. There is only 650,000 naira finance available. Which project should the company accept? So there is only 650,000 naira finance available. So what you are supposed to do here is that, of course, you are supposed to add up what is the finance required for project A, B, D, and E. When you look at the project's initial outlay of project A, B, D, and E, 100,000 for A, 50,000 for B, 100,000 for D, 200,000 for E. That's about that's 450,000 naira. You have 650. You need 450. Is there any constraint? No, there is no constraint. Therefore, project A, B, D, and E should be selected. So let's go and talk about that. Number B now. Projects A, B, D, and E required 450,000 naira of finance. Well, let me change it to capital. 450,000 naira capital, or require capital of 450,000 naira. But the finance available is 650,000 naira. Therefore, since the finance available is higher than the finance required projects A, B, D, and E should be undertaken. Okay, so how do we come about the 450,000 finance required? So the finance required is derived as projects outlay, project A, B, D, and E. Project A requires 100,000. Project B, 50. Let me confirm. Yes. Then 100, 200. When you add it up, that will give you 450,000. That's the total finance required. So that's that. We have answered number B requirement because the finance available is 650 and the company needs only 450. So there is no constraint. Okay. Move on to the next one. Number C. The company faces capital rationing in year 0. There is only 225,000 naira of finance available. None of the projects can be delayed. Which of the projects should the company accept? So you can see now, in this requirement number C, the finance available is limited to 225,000 naira, and the company required 450,000 naira. So there's a constraint. So what do you do? So the most important thing you need to do, of course, in this case, examiner has already computed NPV for us. So what we need to do now is to just allocate the 225. So I don't need to waste time on this. So all those 5 or 6 procedures I told you under divisible projects. So let's apply them. I don't need to follow the 6 procedures. I will use one table to do everything. Examiner has already computed NPV for me, so I don't need to sweat myself to do that. So I'll just say number C. Allocation of finance available of 225. 225,000 is what we want to allocate. So you are going to create about 7 or 8 columns. The first column is for projects, followed by initial outlay, followed by NPV. I did not tell you when I was explaining. At all time, always use benefit cost ratio. The benefit cost ratio is faster and easier to compute than the profitability index. So whenever you want to do your ranking, always use your benefit cost ratio as a tool. So NPV, then BCR. All right, BCR. Then after I've computed the BCR, I need to rank. After ranking, I will allocate allocation. So this will be in naira, then the percentage I've allocated. Then finally, I will have my NPV. Okay. All right. So we have project A, B, D, and E. All right. Okay. Total. So the finance available is 225,000 naira, 100%. Okay. Now, I'll go back to the question, what's the initial outlay of project A? Please give it to me. What's the initial outlay of project A? 100, 50, 100, then 200. NPV. NPV of project A,
60,
60,
40,
next,
110,
110, and then
40.
40. So to get the benefit cost ratio is the ratio of NPV to initial outlay. That is NPV divided by outlay. So 0.60 divided by 100 will give us 0.6. 40 divided by 50 will give us 0.8. 110 divided by 100 will give us 1.10. Then 40 divided by 200 will give us 0.20. The next thing I need to do is to rank my BCR in a descending order. That is according to the highest. So this is first, second, third, and then fourth. So that's the ranking. Now I want to allocate the finance available of 225. So I will do my allocation on the basis of the ranking. The highest ranking is project D. Therefore, out of the 225, project D requires 100,000 naira initial outlay. Give it to it. So because there's no restriction for the allocation to project D, that is, I've allocated 100%. The next one is project B. I have a balance of 125,000 because out of the 225, I've already allocated 100,000 to project D. So I'm left with 125. Out of the 125, project B require 50,000. Give it to it. So 100% of that I've allocated. Again, the next one is project A. I have a balance of 75,000 because out of the 225, I've allocated 150. I'm left with 75,000. Whereas project A requires 100,000. I have only 75,000. I cannot give what I don't have. So I have to restrict allocation to A. Allocation of A, I will restrict it to 75. Therefore, what is the percentage allocated to A? The percentage of A will then be equal to, I've allocated 75,000 out of 100,000. That is 75%. So here is 75%. So the NPV of the allocations that I've done, so 75% of 60, okay? 0.75 multiplied by 60 equal to 45. Here is 45. 100% of 40, that's 40. 100% of 110, that's 110. Therefore, which of the projects to be selected? So I would then say projects, we started with the highest ranking. So project D, B, and 75% of A should be selected. So that's that. So because projects are divisible, that's why we are taking 75% of project A. Okay. NPV of A equal to 75% multiplied by 60 equal to 45, so that you know how we arrive at 45. So let's move to the next one now. Number D. The situation is as in C above, except that you are now informed that projects A and B are mutually exclusive. Which projects to be accepted? The finance required is still limited to 225, but project A and B are now mutually exclusive. So what are you supposed to do? Number D. In my LL explanation, I told you that when projects are mutually exclusive, the most important thing to do is to create two hypothetical groups and make each mutually exclusive project to head the group. Any group with a higher total NPV should be selected. So I would then say where projects A and B are mutually exclusive, meaning that we cannot accept project A and B together. Okay. So I would then say allocation of finance available of 225,000 naira. Okay. So I will start with group 1. Just repeat the allocation. So here will be projects, outlay, NPV, benefit cost ratio, ranking. Okay, then allocation, NPV. Let me write that. All right. Okay. So because project A and B are mutually exclusive, so in the first group, project A will appear, D and E. Project B will never appear because we are making it a project A, the leader of the first group. Project B will not appear in this. Okay. Total. So you want to allocate 225,000. This is the 100% of the finance. The initial outlay of project A is 50, no 100. D is also 100, then 200. NPV of A is 60, 110, then 40. BCL 0.6, 1.1, then 0.20. So all I need to do is to rank. This is first, second, then third. So I want to allocate 225. So starting from project D, out of the 225, project D is asking for 100,000. So I've allocated 100%. 100% of 110 will give me 110 NPV. I'll move to project A, which is the next highest ranking. Out of the 225, I've allocated 100,000. So I have 125. Out of the 125, project A is asking for 100. So I'll give it to it, 100. 100%. 100% of 60 MPV is 60. Then project E is the third. Project E is asking for 200, but we have just balance of 25. So give it to it. That's what you have. Therefore, allocation to E, the percentage allocation to E will be 25 divided by the initial outlay of E of 200. So that will give you what? Okay. That's 12.5%. So the NPV of E will then be equal to 12.5% multiplied by 40. Okay. Multiplied by 40 equal to 5. Here is 5. Add it up. That's 175. I will do the same thing for the second group, group 2 now. Group 2. Projects, outlay, MPV, ranking, allocation, then MPV. So in the second group, project A will not appear. Project B, D, and E. Okay. All right. So we want to allocate it to 5. Project B has initial outlay of 50, 100, 200. MPV is 40, 110, then 40. Ranking. Oh, so I did not include BCR. BCR. Ranking. Okay. So the BCR is 0.8 for B. Let me write that. Too small. 1.1. Then 0.20. First, second, third. So out of 225, project D is asking for 100. I've allocated 100%. 100% of 110 MPV is 110. Project B requires 50 out of the balance of 125. Give it to it. So 100% has been allocated. 100% of 40 is 40. So we have a balance of 75,000. Project E requires 200. Only 75 will be allocated. So what's the percentage allocated for E? So 75 divided by 200 equal to 75 divided by 200. That's 37.5%. Therefore, the MPV of E will then be equal to 37.5%. 37.5% of 40. Okay, multiply by 40, that's 15. So here is 15, 37.5%. Add it up, that's 165. So group A, group 1 produced a total NPV of 175. Group B produced a total NPV of 165. That is 12.5%. Okay. So group B produced a total NPV of 165. So group 1 with a higher total NPV of 175 should be selected. Therefore, I would then say projects D. Let's go back. We are advising on the basis of group 1. So project D, A, and 12.5% of E should be selected. Group A, Group D, A, and 12.5% of E should be selected. So this is what you need to do where projects are mutually exclusive. The next one, that's number E. We are told that the situation is as in C above, that is, the finance available is still restricted to 225, except that you are now informed that projects A and B are mutually dependent. Which projects should be selected? So projects are mutually dependent. And when projects are mutually dependent, the most important thing you need to do is to combine the NPV and outlay of the mutually dependent projects together. Then you do your ranking, you do your allocation, then you advise on the projects to select. So in this case, number, is it D or E? Number E. So where projects A and B are mutually dependent, it means that they must be accepted together. Okay. Allocation of the finance available of 225. Okay. So create a column for projects, outlay, NPV, BCR, ranking, allocation, then NPV. So we are told that projects A and B are mutually dependent. Therefore, project A and B. Then I have project D, I have project E. Okay. All right. 100%. You want to allocate it to 5. So, like I said, since project A and B are mutually dependent, so you are supposed to add the initial outlay of project A and B together. Initial outlay of project A is 100, project B is 50. Add it up, that's 150. Initial outlay of D is 100, E is 200. NPV of project A is 60, NPV of project B is 40, that's 100. 110, 40. So BCR 100 divided by 150. That's 0.67. 110, 0.20. Ranking, this is first, second, then third. So we want to allocate it to 5, starting from D. D is 100, that's 100%. NPV of D is 110. Then combine A and B. Out of the 225, you have allocated 100. So you are left with 125. And A and B is asking for 150. You have only 225. You only have 125. So give it to it. Nothing will go to E. Therefore, what's the percentage allocated for A and B? Percentage allocated for A and B is equal to 125 divided by 150. Okay? 125 divided by 150 equal 0.83%. Okay, that's 83%. So here is 83%. So the NPV of A and B is equal to 0.83 or 83%. 83% multiplied by 100. That's A3. So that's that. I would then say projects D and 83% of A and B should be selected. Guys, I hope you are following. I don't know why your class is always boring. You don't contribute until you are asked. Are you following, guys?
Yes, sir.
Yes.
Each time, I don't know why. I don't enjoy your class at all. It's always quiet. Only me will be doing the talking. You don't contribute anything until you are asked. Okay, please. Let's change. All right, so the next item. So we are done with number E requirements. Let's move to number F. Okay. In the F, you are told that all projects are now independent but indivisible. All projects are now independent but indivisible. Which project should be accepted? Assume that there are no alternative investment available for any surplus funds. So examiner has told you that projects are indivisible. Remember, when I was explaining the concept, under indivisible projects, the most important thing you need to do is to carry out project combination. If NPV is not given to you, you need to first thing first, calculate the NPV, then you now carry out project combination through trial and error. You allocate the finance available, then you accept any combined project with highest total NPV. Okay, so that's what you need to do. So since projects are indivisible, let me move to the next one, number F. indivisible projects. Okay. So under the, since NPV has already been given to me, so there's no need for me to compute NPV again. Then. So the first column will be, it's just a format you're supposed to follow. So the first column will be the project combination or combined projects, followed by combined outlay. Then you may have surplus fund. Then combine NPV. Okay. Allocation of finance available of 2 to 5,000. Okay. Now, you have to pay attention here. When you are doing your project combination, you have to take into consideration the finance available. So in this question, the finance available is limited to 225. Therefore, we are going to be combining the projects consistent with the finance available. So we go back to the question. When you look at the finance available, let me put it here so that we'll be able to see it in summary. So we have project A, B, D, and E. Outlay of project A is 100, 50, 100, then 200. So like I said, you'll be carrying out project combination. Don't go and be doing this on the day of your exam. This is not part of it. It's because I don't want to be switching from one page to, from the question material and this one. That's what I just put this one by the side. Now, what we want to do is to combine projects. You are going to look at the initial outlay of each of the projects that you want to combine, starting alphabetically. Can I combine project A and B? Yes. A and B's outlay is 150. Finance available is 225. Therefore, it's within the 225. So I can say A and B. A and B outlay is 150. Okay, 150 minus 225 will give us surplus funds of 75,000. Then the NPV of A and B is 100. Here is 100. Okay. Next. I cannot, yes, I can combine A and D. So A and D. A and D, it will be 200. Surplus fund is 25. That is 200 minus 225. Then the NPV of A and D is 170. 170. Then I cannot combine A and E because A and E outlay is 300, which is more than the finance available. Remember, under indivisible, 100% of the project must be accepted. There is no fraction. You can't take fraction of a project. It's either you accept the project 100% or not. Okay, so that's that. Now I'm done with alphabet A. I will go to B. So I can combine B and D. So I will say B and D. B and D outlay is 150. Surplus fund is 75. NPV of B and D is 40 plus
50.
110. That's 150. Okay. Then I cannot combine B and E because B and E outlay is 250, more than the finance available of 225. So finally, I can just say D. I can say D, or I just ignore. I just say D and E. D outlay is 100. Surplus fund will be 125. NPV is 110. E is 200. 25 balance. Then NPV of that is 40. Yes, I'm done now. This is what you need to do under indivisible projects. Okay. So if that is the case, I need to select which project to undertake. I'm going to select any project with the highest total NPV. When you look at projects A and D combined, we have 170 relative to other options. So this is the highest, therefore, project A and D should be selected. Projects A and D should be selected. Okay. So that's the decision. This is how to carry out project combination where there are indivisible projects. That's what you need to do. Okay. Then the next one, you are told that all projects are now independent but indivisible projects. No, I've done that. Number G, rather. Number G, same as F above, except that you are now told that surplus funds can be invested to produce 12% and 8% to perpetuity. So we want to invest surplus fund. Remember my explanation. Surplus fund can only be invested if the reinvestment rates is greater than the company cost of capital. So number G now. Number G, Roman figure 1. Investments of surplus fund at 12%. Okay. Investment of surplus funds at 12%. So we can invest. I would need to compare it with the company cost of capital. According to the question, the company cost of capital is 10%. Therefore, I would then say the option to invest surplus funds at 12% is financially viable, since the reinvestment rates of 12% is greater than the company cost of capital of 10%. Okay. Therefore, the surplus fund of 25,000 naira should be invested. Therefore, the surplus fund of 25,000 naira, is it 25? Yes, should be invested at 12%. The NPV of the surplus funds, the NPV of the surplus fund is dash, I don't know. as calculated below. So let's go and compute the NPV of the surplus fund. So NPV of surplus fund is computed as the reinvestment rates multiplied by the surplus funds divided by the company cost of capital minus the surplus funds. Okay, the surplus fund, the interest rate on the surplus fund is 12%. Surplus fund is 25,000 naira minus company cost of capital of 10% minus surplus fund of 25,000. So what do you have there? 0.12 multiplied by 25,000 naira equal divided by 0.1 equal minus 25, that's 5,000 naira. So the NPV of the surplus fund is equal to 5,000. I will then come and put it 5,000 naira. So that's that. I'll move to the next one, which is option to invest surplus funds at 8%. High, G high. Investments of surplus funds at 8%. Okay. So I will say the option to invest the surplus funds of 25,000 naira at 8% is not financially viable, considering the lower reinvestment rates of 8% relative to the company's cost of capital. Okay, of 10%. Under single capital rationing, under single period, capital rationing. The most important thing to do is to return the surplus funds to the shareholders in form of dividends or bonus. Let me write that. Bonus shares. Okay, that's what the company should do. Because once the interest rate from the surplus fund is lower than the company cost of capital, that means it's not viable. So the most important thing the company will need to do is to return the surplus fund of 25,000 naira to the shareholders in form of dividend or bonus shares. So the reinvestment rates, I mean the investments okay, let me put it this way. If the surplus fund is invested at 8%, it will bring about a diminution in the wealth of the shareholders. For this purpose, the NPV of the surplus funds will be dash. I don't know. So I need to go and work it out first. Will be dash. Then as shown in the calculation below. So let's calculate the NPV of the surplus fund at 8%. So NPV of surplus fund equal to 0.08 multiplied by surplus funds of 25,000 naira divided by cost of capital of 10% minus 25,000 naira surplus funds. So this will be equal to 0.08 multiplied by 25,000 equal divided by 0.1 equal. That's minus 5,000 naira. So here will be minus 5,000. That's negative NPV. You see, when you have a negative NPV, the value of the company will drop by that amount. And that's why it is not financially viable to invest surplus funds at the rates below the company cost of capital. So that's that. Let me know. So we have 2 more to go. Let's go to H. Before we move to H, let me know if you have any questions so far, or we just go ahead straight. You can see only one question since. Yes, talk to me.
Okay. What if the rate of investing the surplus fund equals the company's cost of capital? What do we do?
Well, that means your NPV will be equal to 0. The NPV of the surplus fund will be equal to 0. So you are at liberty to either invest the surplus fund or not to invest it, depending on other qualitative factors. Okay.
Then,
All right.
then the reference was on single period capital rationing. What if it's
Yes.
multiple period?
No, it will not happen. It will not happen under multi-period capital rationing. Remember, the only thing you need to do under multi-period capital rationing is to formulate a linear programming. So you are not asked
To now
to,
select the project.
yeah, you are not asked whether you should select any project. The most important thing you need to do is just to formulate, because you need decision support system, computer integer to be able to carry out the analysis. You can't use it, you can't solve it manually. And that's why the highest examiner will ask you to do is to formulate the linear programming under multi-period capital rationing. Yeah. Okay, so let's move to H. Under the H, you are told that all projects are independent and divisible. There is capital rationing in year 1. No project can be delayed or brought forward. Which project should be accepted if maximum external finance available is 150,000 naira? So what the examiner is trying to tell you in this H requirement is that, so far so good. All our calculation has been based on the fact that the financial constraint is in year 0, 225,000 naira. But now examiner is telling you that there's financial constraint in year 1 only. Okay, there's financial constraint in year 1, and the finance available is limited to 150. What are you supposed to do? So to solve this number H requirements, when you look at year 1, you will notice that all the project has negative cash flows. Okay, all the project has negative cash flows, except project C. Project C has a positive cash flow of 100. Of course, we have taken project C. We have condemned project C ab initio because it's not financially viable and it's a prodigal son as a result. But in this year of constraints, project C is bringing in cash flows of 100,000. Therefore, the most important thing you need to do in this situation is that because the finance available is limited to 150 and the finance required to execute projects A, B, D, and E is 300,000. So you only have 150,000 out of the 300,000. So what you need to do, the most important thing to do here is to collect the 100,000 naira of project C, add it to the existing 150,000 naira, and make project C the loss leader of the table. Then that's option one. Option two is to allocate the entire 150,000 naira to the viable projects. So any of the options with a higher total NPV should be selected. Now, technically, this is what I'm trying to say. Let me comment shortly. That's number H. So I can say in the year of constraints, project C, in the year of constraint, that is year one, that is year one, project C has a positive cash flow of 100,000. Therefore, the most important thing to do is to collect the cash flows of 100,000 naira of project C, and add it to the 16 and add it to the finance available of 150,000 naira, totaling 250,000. That is 100,000 plus 150,000, and allocate the 250 and allocate the 250,000 among competing viable projects based on the ranking. So that's option one. So let's first of all do this option one. This is shown as follows. Okay. So Okay, let me continue. Let me complete that statement. Completing viable project based on the ranking. Why? Write it. Why making projects C the loss leader of the table? This is shown as follows. Okay, so like I was trying to say, in that year one, only project C has the positive cash flows, and you are looking for 300,000 to invest. You have only 150. So what you need to do is to collect the 100,000 of project B or project C, add it to the existing 150, making 250. Then you now make project C the loss leader of the table, because the 100,000 you are collecting from project C is not for free. You also need to consider the negative NPV of that project C. So I would then say projects, I want to allocate the 250. Outlay, NPV, BCR, okay? BCR, ranking, allocation, then NPV. Well, I did not leave a space. Let me just manage it. Allocation of 250,000 naira. Projects B, we are making project C the loss leader of the table. So project C, A, B, D, and E. Right? Total. $250, 100%. So dash, 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 dash. The NPV of project C is 20, negative 20. So here is minus 20. So you are making project C the loss leader. So in year one, outlay of project A is 100, 100, 50, 50. 100, 100, then 50, 50. 60, 40, 110, then 40 NPV. 0.60, 0.40, 2.20, 0.80. So ranking, this is first, second, third, then fourth. Okay? Then I want to allocate 250. The highest is project D. So D requires 50,000. All right, 100% is allocated. NPV is 110. Second is E, 50. 100% is allocated, 40,000. Third is A. Out of 250, we've allocated 100,000, remain 150. And A is asking for 100 out of 150. Give it to 8. 100%, 60. Then B is asking for 100, but we have just 50. So 50, 50%. 50% of 40 is 20. Therefore, the total NPV would then be equal to, that's 210, 210. So this is option 1. Now, let's try option 2. What if we allocate the entire 150,000 among the viable projects? Let's see what we'll have. Option 2. Allocate the finance available of 150,000 among, let's leave that one. So projects outlay NPV BCR ranking allocation, then NPV. Projects A, B, D, and E. Okay. So we are allocating 150,000. Here is 100, 100, 50, 50, 60, 40, 110, 40, 0.6, 0.4, 2.2, 0.8. This is first, second, third, then fourth. We are allocating to D. D is 50, 100%, 110. Here is 50, 100%, 40. A is 100. Sorry, we can't give 100 to A. Remember, we are allocating 150. So out of the 150, 100 is already gone. We are left with 50. Therefore, 50 will go to A out of 100. So 50 will come here. 50% is what we are allocating. 50% of 60 is 30. Add it up. That's 180. You see that? Option 1 has a higher total NPV relative to option 2. Therefore, projects D, E, nothing goes to this one. Project D, E, A, and 50% of B should be selected. A and 50 of B should be undertaken or selected. That's end of H. That's end of H. Lastly, you are now told that, let's go to high. You are told that you are asked to provide a mathematical programming formulation which will assist the directors of Dandimanti PSC in choosing investment projects if capital available in year 1, in year 0 is limited to 225, capital available in year 1 is limited to 150, and capital is freely available thereafter without limit at 10% per annum. So examiner wants you to formulate a linear programming model. If capital available in year 0 is 225, year 1 is 150. So this is pretty straightforward. All right. Okay. Finally, number I. Roman figure number I. Formulation of mathematical modeling. That's linear programming. So this one is pretty straightforward because examiner has already given us MPV. So the first thing I need to do is to state the objective function. Objective function. And as you know, there's only one objective, which is maximization of MPV. Let me push it to the next one. Maximization of MPV. I would then say MPV of project A is 60 of A plus 40 of B, 40 of B plus MPV of C of D is 110. 110 of D plus 40 of E. So with this, I've stated the objective function. The second step that I need to carry out is to state all relevant constraints. Simply say, subject to. What are the constraints? We are told that in year 0, there is constraint of 150. In year 1, that's also a constraint. Therefore, what's the initial outlay in year 0? Initial outlay of project A in year 0 is 100,000. So 100,000 of A plus 50,000 of B plus 100,000 of D plus 200,000 of E less than equal to, that space is short. I need to, okay, let me just manage it. Less than equal to, what's the initial outlay in year 0? The finance available in year 0. I think we are told 100,000.
5.
Sorry, 225. Thank you. It's 225. Let me write this. 225. I pray it will not cut. No, it will cut. The video will cut it. Let me write it. Subjects to year 0 equal to 100,000 of A plus 50,000 of B plus 100,000 of D plus 200,000 of E less than equal to 225. Then in year 1 equal to 100,000 of A plus 100,000 of B plus 50 of E, sorry, 50 of D plus 50 of E less than equal to 150,000. So with this, I've stated the constraints. Then third step is to state the non-negativity constraints. So non-negativity constraints. We state that negative NPV is not permitted. Therefore, project A, B, D, and E, NPV must be greater than or equal to 0. Finally, you need to state the non-repeatable condition, which state that projects cannot be repeated, delayed, or brought forward. Therefore, project A, B, D, and E is less than equal to 1 probability. That is end of the question. So this is how to formulate a linear programming model. So under multi-period capital rationing, this is the maximum examiner will ask you to do. So the worst case is that you maybe have to compute NPV for all the projects. Then after that, you formulate. That's all. So that's end of the question. That's end of the question. So I would have loved to solve one more illustration, but I can't finish it within the next 15 minutes. So let me see. Let me see if I can have one more. Okay, let's have this illustration number 4 quickly. I will not complete it. I will just, because this illustration number 4, NPV is not given. So how do you calculate the NPV? So let me just do maybe A and B. Then you complete the C. All right, quickly, let's have this illustration number 4. So somebody should read for us, please, quickly, within the next 2 minutes. Somebody should read. Who is reading it?
Okay, let me read. Professional Limited is experiencing a shortage of funds for investment in the current year, when only 100,000 is available for investment. No fund shortages are foreseen thereafter. The cost of capital is 20%. The following projects are available. Project 1 to 6, annual receipts and outlay. You are required to advise the management on the project which you would recommend for acceptance if they were A, divisible, and B, indivisible. C, would you answer to B above change if surplus funds can be invested at R1, 12%, 2, 22%, ignore taxation.
Thank you, Jide. Yes, that is the question. Examiner is asking you which of the projects to select if projects are divisible. So without wasting time, so you can see relative to the first question that we solved under the Benti, in this particular question, we are not given the NPV. So how do you compute NPV where you are given cash flow to infinity or perpetuity? So let's quickly solve this question. Okay. So the first thing we need to do now is to solve for NPV. Solution to illustration. What is that for? Solution to illustration number 4. Professional Limited. Okay. So the first thing you need to do is to compute NPV. So I would then say calculating net present value. So it would have been very easy if in the question you have the normal, the normal way you compute NPV is not possible in this question because remember I told you that there are 3 variables that must be present whenever you want to compute NPV. One is relevant cash flows, appropriate cost of capital, and then the useful life of the project. In this question, the examiner has given us cash flows to infinity. Useful life is not given, but that useful life represents infinity. Infinity has has replaced the useful life of the project. So the cost of capital given to you in the question is 20%. So whenever you are given cash flows to infinity and you want to calculate present value, okay, let me design the table first. So I have projects, cash flow, cash receipts, okay, cash receipts to perpetuity, then present value to perpetuity, present value to perpetuity, then outlay, finally NPV. Okay, so we have project 1 to 6. Project 1, 2, 3, 4, 5, and then 6. Okay. When you want to calculate the present value to perpetuity, it's simply the cash flow divided by cost of capital. Okay, cash flow divided by cost of capital will give a cash flow to perpetuity. Let me write it. A divided by R. That's the cash flow to perpetuity. Or if you want to calculate discount factor or annuity factor to perpetuity, discount factor to perpetuity will be computed as 1 over R. Okay, 1 over R. In this case, it will be 1 divided by 0.2. 1 divided by 0.2, whatever you have, then you use it to multiply the cash flow. But that's a long thing. Since you already have the cash flow, just say cash flow divided by the cost of capital. So the cash flow of year 1 is 1520. Call the numbers for me. 1520. What's the next one?
1810,
Okay.
810.
810. All right then. So that's that. Then give me the outlay.
50, 80,
50, 80,
60, 30,
60, 30,
25, 40.
25, 40. Thank you. So what I need to do now is to compute the NPV. Okay, let me design my table first. So I need to compute my present value to perpetuity, which is A divided by R. A is the cash flow. A equal to cash flow, then R equal to cost of capital. So the cost of capital is 0.2. Therefore, 15 divided by 0.2. 15 divided by 0.2 equal to 75. 75 minus 50 will give us 25. 20 divided by 0.2 equal to 100. Here will be 20. 18 divided by 0.2 equal to 90. Minus 60, that's 30. 10 divided by 0.2, 50. Here is 20 MPV. 8 divided by 0.2 equal to 40. Minus 25 is 15. The last one, that's 50 minus 10. Minus 40 will give us 10. Now we have computed our NPV. I can then proceed with the normal procedures. So I want to do what? The examiner has told us that projects are divisible. Therefore, I need to allocate the finance available. How much is the finance available? 100,000 naira. Therefore, I would then say allocation of finance available of 100,000. Here is project, outlay, NPV, BCR, ranking, allocation. Let me write that. Allocation, then NPV. What's your problem? NPV. Okay, so we have project 1 to 6. Project 1, 2, 3, 4, 5, and 6. Okay. We want to allocate 100,000. %. So outlay of project 1 is 50, 80, 60. 50, 80, 60, 30, 25, then 40. Okay, I know this one's to be 10, 15, 20, 30, then 25, 20, 25. Okay, so my BCR, 25% of 50 is 0.5. 20% of 40, sorry, 20%, 20 over 80 will give us 0.25, 0.5. Five, 0.6, then 0.25. Okay, so now we want to rank. That's one of the reasons why I have to select this question. Jide, you can mute. Jide, So, yes, you will notice that the benefit cost ratio computed for each of the projects, some of them are ties, some of them ties. For example, we have 2.5s, then we have 2.25s. So we want to do our ranking now. The highest BCR is project 4. 4 is first, followed by project 5, second. Third is project, you can see, the next one is 0.5, and project 1 and 3 has highest ranking. So has the same ranking of 0.5, the same BCR of 0.5 rather. Therefore, how do you know which ones to allocate first as third position? So where project BCR ties, Then the next thing you need to do is to allocate to the project with the higher NPV. So project 3 has a higher NPV of 30 relative to project 1 with NPV of 25. Therefore, this will be third. Then this is fourth. Again, project 2 and 6 tied at 0.25 DCR. So you are going to allocate to the project with a higher NPV. Project 2 has a higher NPV, which is fifth. Then this is sixth. So that is how to allocate where projects have the same benefit cost ratio or profitability index. So I want to allocate 100,000. Okay, my figure is even in thousands, so I don't need to stress myself. Let me just remove. This is 100,000. So we are going to allocate to project 4. Project 4 requires 30,000 out of 100. Give it to it. Here is 30, 100%. NPV of that is 20. Next is project 5. Project 5 requires 25 out of the balance of 70. So give it to it. Allocated 100%. NPV of that is 15. Next is project 3. Project 3 requires 60,000, but we have balance of 45,000. So you can't give what you don't have. So restrict this one to 45. Therefore, for project 3, we have allocated 45 out of 60 initial outlay. What percentage is that? 45 divided by 60, 75%. So we've allocated 75% of project 3. Therefore, NPV of project 3 is equal to 75% multiplied by 30. Okay, that should be 30 multiplied by 0.75. That's 22.5. 22.5. So here is 75%. NPV is 22.5. Dash, dash, dash. Nothing goes to that because we don't have again. So that is for divisible projects. This B part is indivisible projects. So we carry out project combination now. Number B, where projects are indivisible. Okay, so you carry out project combination. I would then say allocation of 100,000 naira. Okay, I want to allocate 100,000 naira. So first thing first column will be project combination, combined, projects, combined, outlay, surplus fund, then combined, net present value. Of course, our figures are in thousands. Now, we want to combine outlay of projects, knowing fully well that we have just 100,000 naira finance available. Therefore, the NPV, the outlay of project 1 is 50,000 naira. Outlay of project 2 is 80,000. Please call the numbers for me so that project 1, 2, 3, 4, 5, 6. Here is 50. Here is 80. What's outlay of project 3?
60.
60. Project 4?
30. 25.
and
40.
then, okay, thank you. Okay, then let me write this one to 80. What's wrong with you? Now, you can see that we cannot combine the outlay of project 1 and 2 because it should be more than the finance available of 100,000 naira. So 1 and 2 cannot go together. 1 and 3, that will be 110, which is more than the finance available. They can't go together. 1 and 4, that's 80. Yes, I will say 1 and 4 can be combined. So 50 plus 30 will give us 80. Okay, surplus fund, 80 minus 100 will give us 20. NPV of 1 and 4 is, what did we get the other time? NPV of 1 and 4, 25 plus 20, that's 45. Here is 45,000. Then I can combine 1 and 5. 1 and 5 is 75, which is within 100,000. 1 and 5. 75. Surplus fund is 25. NPV of 1 and 5. Okay.
40.
25, that's 40. Thank you. Here is 40. Then I can combine 1 and 6. 1 and 6 is 90. So 1 and 6 can go together, which is 90. 90 minus 100 will give us 10. So NPV of 1 and 6 is 35. That's 35. So I'm done with option 1 because it has to be, you have to analyze it numerically. So after 1, the next one is 2. I cannot combine 2 with any projects. Project 2 cannot be combined with any project because that one is 80. I will say 2. Here is 80. Surplus fund of 20. Then NPV of project 2 is 20. Then project 2 cannot be combined with any other project. So that's it. Then I move to project 3. I can combine 3 and 4. 3 and 4, which is 90. Surplus fund is 10. NPV of 3 and 4 is 50. Here is 50. Then I can combine 3 and 5. 3 and 5 is equal to 85. Balance of 15. NPV of 3 and 5. That's 30, that's 45. Then I can combine 3 and 6. 3 and 6 is equal to 100. No surplus fund. So 3 and 6 NPV, that's 40. 40. Then I can combine 4, 5, and 6. 4, 5, and 6 is within the finance available. So I will say 4, 5, and 6. I don't need to stress myself, which is 95. Balance of 5,000. Then NPV of 4, 5, and 6. That's 45. Here is 45. So I'm done with my project combination. All I need to do now is to select the project to be undertaken. Okay. When you look at the combined NPV, the highest combined NPV is 50. Therefore, project 3 and 4 should be selected. That's it. Projects 3 and 4 should be selected. So that's it. So the last one, examiner is telling you to advise whether the surplus fund of 10,000 naira should be invested at 22% and 12%. So you can do that one on your own. I've given an example under the bounty. So yeah, that's it. That's end of the question. That's end of the question. So thank you guys for your patience. Let me know if you have any question for me before we close the class. Any question? If there is none, we close the class. I'll see you again next time by the grace of God. Thank you for your patience. See you next time by the grace of God. Good night, everyone.
Thank you, sir.
Good night.
Thank you. Good night, sir.
Good night.